Okay, today's bank is Columbia Financial. It's located in New Jersey. Ticker of CLBK. And the interesting thing about this bank is that it is about 70% owned by an MHC, mutual holding company. Essentially means it's 70% owned by its depositors, and then maybe 30 something or 20 something percent owned by normal individuals or other companies, typical shareholders, right? Stock ownership. So when we're going through this, we're going to consider the MHC as a normal shareholder, right? They just happen to own 70% of the thing and perhaps have control, right? But for me and you, who could, potentially buy the bank, we would own a certain number of shares, small number, and we would share in the earnings and dividends and net assets of the company in the same, by proportion of the number of shares we have compared to the total number of shares. So we're gonna look at it from that perspective. Some other banks that are owned partly by MHCs might withhold their dividends, or refuse to receive the dividends on the MHC shares, which if you think that that's going to continue on forever, then you can make an argument that technically the minority shareholders share in the entirety of the earnings rather than MHC. But that's not the case with this bank, so it makes it a little bit easier to think through. Anyway, so the stock price, it looks like, most banks that we've seen over the past year have had a little up like this, another little up, and then right here, year to date, they decide whether it's going to go up or it's going to go down. This bank went down. So perhaps some things that were not good for the bank happened over the past year to date compared to the average bank. So we'll see once we dig in. We can see that it's a PE ratio of about 97. That's really, really high. Most banks are around 10 times earnings. So either the loan earnings are really low or the stock price is really high, right? And we'll see once we get in. Also, there's no dividend being paid. So without a dividend, the only way that you can share in the earnings or the profitability of the bank would be through capital appreciation. So if we come over to the statistics side, we can see some more things. So the trailing PE 97, it's gone up and up and up and up over the past several quarters. And then the price to book is about 1.5. That's also really high. We typically see somewhere between 0.8 and 1.05 for price to book. So really high price relative to the earnings and whether to the book, the net assets. So once we dig in, we'll learn whether that higher price is reasonable based on the profitability of the bank, or its risks being more muted than other banks. So we'll see. But we can see the return on assets 0.15%, so it's really, really low. Typically see something like 0.8 to 1.05%, so really low profitability there. Even on the return on equity is about 1.5%. That's really, really low. Also, profit margin's really low. So that tells me that more than likely we're going down the path of a bank that is either not profitable or very low profitability. So, and we don't buy banks that aren't making good money. So this might be a no-go, but let's look at what's going on. Columbia Financial, we can see the balance sheet. All right, so we've got cash of about $373 million. That's about 3.5% of the balance sheet. A little on the low side, but pretty close to the average. Usually somewhere between 4 and 5% is what we see, so pretty average. Securities of about $1.5 billion when we add the available for sale and held to maturity, and that's about 14%. That's pretty average. And then loans of about 7.8 billion. It's about 73% assets. So that's very average as well. So we're really looking at an average asset side of the balance sheet. And also if we look at the leverage, it's about 10 times. So assets divided by equity is about 10 times. So that's very average as well. We typically see somewhere right around 10. So that leads me to believe that more than likely the bank has a pretty average interest income amount. So when we get to the income statement, we'll see if that's the case as well. But also, average liquidity, average capital, those types of things as well. So we've got here the deposits of about 7.8 billion. They didn't split out between non-interest bearing and interest bearing. On the balance sheet, they do a little bit farther down, so we can look there and see how things are allocated. But they also have about $1.5 billion of debt as well, which is about 16%. That's a little on the high side. Most banks we see somewhere between 6 and 9% of their liabilities are debt. So the debt is a higher cost source of funds as compared to perhaps non-interest bearing deposits, of course, but also compared to time deposits, money market accounts, that type of thing. So they're being allocated a little more towards debt might mean that they've got a little bit higher interest expense than the average bank. But let's look at the deposits. I'm just going to skip down there really quick. Okay, so here's the footnote about the deposits, footnote 11. So I've got about 1.4 billion of non-interest bearing deposits, which represents about 15% of the liability side of the balance sheet, which is a little bit on the low side. So not as much non-interest bearing deposits as most banks, and we would prefer to have as much non-interest bearing deposits as we can get, right? So that in conjunction with them having a higher allocation to debt might mean that interest expense is a little bit higher than the average bank. So when we get to the income statement, we'll see if that's the case. So let's shoot back up there. So on the income statement, we have about 108 million of interest income. That's about 4.47% of assets, and that's really, really low. I mean, most of the banks that we're looking at now have something between like 5.5%, 6%, even a little bit higher. So at least for this quarter. So they're being at 4.5% is really, really low amount. And it looks like it's due to both loans and securities being at lower yields. So the loans, 92 million. If we did that as a percentage of the loans on the balance sheet, that's about 4.75%. Most banks now are at least 5.5%, 6% on their loans. So I'm not sure why their loans are yielding such small amounts, but that's not good. And on the security side as well, about 10% interest income on the securities. That puts them at about 2.5%. That's really, really low also. I mean, most banks, the securities are yielding 3.5% at least. So, for whatever reason, I'm not sure, but they have really, really low yields on their loans and securities, and that's keeping their interest income really, really muted. Ouch. So yeah, and the deposits, we've got 48 million, and that's about 2.5%. Yeah, it's a little bit on the high side, probably close to what we're typically seeing during this quarter as we're going through all these financial statements. But 2.5% is pretty high on the deposits, and then interest on debt's about 4%, that's a pretty good yield on the debt actually, especially when we see a lot of it ends up being 5.5% perhaps. So pretty good yield on the debt, but overall 66 million on interest expense. That's about 2.8%, which is a little on the high side as we were expecting, but not egregiously so. It's fairly common to see that much interest expense on the income statement. So, but anyway, so those things together gets us about $42 million interest income, which is about 1.6% net interest margin. And that's really, really low. It's probably half of what we normally see. So they're earning half the income on their assets compared to most banks. And it's mostly due to this interest income being way, way less than what the typical bank has on their income statement. So that's not good. Coming down to the non-interest income, one of the things that we did was take out the securities loss, to take it out from the non-interest income. It's sort of a non-recurring type of thing. And we also consider this when we look at the price to fair value of the bank as well. So take that out, and that results in about 8.8 million of non-interest income. That's about 7% of the assets. So it's a little on the low side as well. We're typically seeing something at least 10%. So it looks like maybe there's not some kind of wealth management or insurance type of services provided by the bank. So then, maybe they don't make as much non-interest income as what the average bank might. But then also coming down to the non-interest expense, we have about a little over 45 million of non-interest expense, and that's about 39% of the revenue. And it's a little on the low side, which is great. The lower the better, right? But it's not really far outside that range. So I think it's not helping us a whole lot to shore up the lower net interest income as well as the lower non-interest expense. Yeah, so at the end of the day, it puts us at a loss. And this is taken into account the loss in the securities. But if we remove the loss on the securities, it puts us at pretty much break even, about $0 net income. So that's not good. The bank is definitely underperforming. We typically see a return on assets for most banks around 0.8 to 1.05 currently. So if this bank had been earning the average amount, should be earning about 1% of this 10 billion. Wow, so that would be about $106,000, right? So, but we did say that their net interest income, that's where I went wrong. So we'd have to divide it by 4 to put it on a quarterly basis. So about $25,000 a quarter would be a normal average profit for a bank this size, right? But they have zero. So adding $25,000 to this would, might be a pretty big endeavor to do. And it would basically just be, if they could get the loans up to normal market yields, they could increase the spread on the net interest income and put them in a pretty good position. But I'm not sure why their loans are yielding such a small amount, and perhaps we learn a little bit more once we get into things. But as it is, it's a bank that's not making any money, and we don't buy banks that aren't making money. So, I think that we're already decided that we're gonna just move on, right? But it'll be nice to see what's going on with the bank, so we can get a good understanding. Maybe next year they improve the yields on their assets, and it might be a better looking bank at that point. So let's dig through the footnotes. So this tells a little bit about the MHC structure. They have two banks, so Columbia Bank and Freehold Bank, and then a couple of subsidiaries. They're wholly owned by Columbia Bank MHC, not wholly owned, but majority owned. But that's not consolidated into this thing, so we're treating it as it's just a normal shareholder, just like us, right? If we owned the bank. All right, so let's shoot down to the securities. Yep, so we've got some available for sale ones. There's also some held to maturity ones. They've got them split up, so we sort of have to um, add up several tables to get to where we want to get to. But if you were to add them all up, we get about 1.2 billion of mortgage-backed securities and about 280 million of agencies. And both of those together gets us about 95% of the securities portfolio. So that means 95% of the securities portfolio is riskless. So that's fantastic. Nothing to really explore further regarding the credit quality of the securities portfolio. It's not really a material part of our analysis. I think the remaining 80 million or so is corporate securities, which I think are securities of other financial institutions, which is a fairly common practice for most banks to own the securities of other financial institutions. So let's go down to loans. Okay. All right. So if we added all these things up, so looks like 1 to 4 family residential mortgages are the largest allocation. So that makes a little more sense now on why maybe the interest income is pretty low, because the yields on these types of loans are pretty small, right? Especially if they were originated at least a few years ago when those interest rates were really, really low. Thinking 3.5% 30-year fixed mortgage, right? So they've got a large portion of those on their balance sheet, on their loan portfolio. It's about 36%, which is probably about double of what we would see most community banks being in. And next is commercial real estate, which is at about 30%. When we combine it with the multifamily, it puts us about 38% of the loan portfolio in total, which is a pretty average common amount. But so that means about 93% of the balance sheet is real estate loans. There's not a lot of C&I. Only about 7% of the portfolio is C&I, which we would typically see somewhere between 15 and 22-ish, sort of. So really low allocation to business loans, but a really high allocation to real estate loans, and more so to the residential side. So that really clarifies why perhaps interest income is pretty low, or a whole lot more allocated toward residential real estate, which has lower yields, and also commercial real estate, which might have lower yields than what would typically be seen for the C&I. So that's what it is. They have lower return, lower yielding allocation to loans than most banks. But that might also mean that they've got a lower risk of credit quality, right? So we'll learn a little bit more about that by looking at some of these tables down here. So they've got past dues of about 33 million plus non-accrual. That's about 0.73%. About 56 million. It's about 0.73% of the loan portfolio, which is a pretty average amount. So not too bad. It's very, very average. And then for the non-accruals themselves, about 23 million. It's about 0.29% of the loan portfolio. That's pretty low as well. So nothing really major regarding credit quality there to be concerned about. And so they don't have any real estate owned. Now let's see what allowance they have in place. So they have 55 million, it looks like, and that's about 0.71% of loans. That's a really, really low reserve. Most banks have somewhere between 1.10, 1.25%, so they're having 0.71% of a reserve. Leads me to think that the reserve might not be appropriate, especially when we see that the past dues and the non-accruals come in at about an average percentage of loans compared to most banks. But this bank has a lower reserve than most banks do, so perhaps that would mean they need a higher reserve, which would require a larger provision, which would hit the income statement and make them even less profitable, right? So let's keep going and see if we can get to see how much of the classified loans are in place. They don't have a whole lot of TDRs either. Pretty average amount of TDRs, so loans that were modified. And collateral dependent loans are about average as well. Where are the classifieds? Here they are. Okay, so substandard and below is what we consider the classified loans. And those are the ones that have an identified risk that makes it more likely that they're not going to be paid back in full. So we add these up. So we've got 6 million and 34 million of the commercial real estate, and then some commercial business. It seems like a lot for the commercial business considering it was one of the lower allocation of the loan portfolio, right? Anyway, so when we add all these together, we get about 66.4 million, and that's about 0.86%. So that's actually a really low amount, a really low percentage of loans. We typically see somewhere between 1.10, 1.65%. So they've got an amount of classified loans on the lower side. And it looks like the commercial and industrial, about 5% of those loans are classified. So, but they're less allocated towards those loans, right? So it's a smaller overall number. Anyway, so if we look at all this together, we can see that, we typically look at ratios of, well, what's the reserve compared to the past dues? What's the reserve compared to the classifieds? What's the past due compared to the non-accrual? And for all of those, they're below what the average bank has. And that's because of the reserve being only about 0.71% of loans, which is very far below what we would typically see, which would be around 1.10 to 1.26% of loans. So all of these ratios of reserve to past dues, non-accruals are below what we would prefer. So I would say that more than likely they're going to need to increase the reserve to a higher amount, and that would hit our income statement and reduce our profitability even further. And currently on the income statement they have zero net income anyway, so it's puts the bank at a higher risk for having more of a loss, right? So that's not what we want to do. So anyway, so we can carry on here past the leases. Deposits we talked a little bit about. They've got about, I believe, 1.9 billion of uninsured deposits. Maybe they discuss it elsewhere. Yeah, they must talk about it in MD&A. We can see it once we get there. Another thing to note is that a pretty large amount of the shares and compensation end up going into the stock-based comp to the employees. Like if we were to add up the 620,000 unvested shares and then about 3.8 billion of options, which of course all of them aren't going to be exercised, but those together equals about 4.25% of the shares outstanding. So that's, not that unusual. We usually see somewhere between 2 and 4% of outstanding shares being unvested within the stock-based comp. So just something to keep in mind, that they will be issuing more shares, which dilutes our own ownership if we were to own the bank, right? And then another thing, all of these shares, when they issue them before they're vested, they basically amortize that cost over the vesting period, right? So it's not expensed immediately. So over the next, 2 or 3 years, whatever the vesting period is, there will be more interest expense added to the income statement. Anyway, so if you were to add up everything that they talked about was interest or expense that they're going to make over the next 3 years, then it adds up to about 11.7 million, which is 26% of the compensation. So about a quarter of what's in the compensation now will fall into expenses in the future as well. So something to keep in mind for assessing the future profitability of the bank. They've also got a pension, but it doesn't end up being a very material effect on the financials. But we can get to the fair values here. We normally convert carrying values to fair values to see, what is the market price compared to that, as well as what is the capital that they have in place adequate from a fair value standpoint, right? And so they have some held to maturity securities, so those will have a decrease in value from the balance sheet down to fair value, but also loans. So we can see loans is maybe $500 million, and then securities maybe 400,000 or 40,000, 40 million actually. So if we add those things up, then it's about a $575 million reduction to assets, which is about 55% of equity. So if we take everything on the balance sheet and convert it to its fair value, then it wipes away 55% of the equity. That's kind of a lot. Even in this environment where interest rates went up a lot and all banks have sort of unrealized losses sitting in most of their assets because of that. But 55% is a big downward shift in the equity. So if we were to take the assets minus the liabilities at fair value and compare it to the stock price, to the market cap of the bank, it gets us about 4.56 times, and that's a really high ratio. Most banks are somewhere between 1.5, 2.5 times that you would pay for the fair value of its net assets, right? But this bank is basically double that price. It's crazy expensive because the tangible fair value here, the assets minus liabilities of this, is about 360 million, but the market cap of the bank is 1.6 billion, right? So if you went and bought the bank today for 1.6 billion, $1.6 billion market cap, you would get net assets with a fair value of about 360 million. So that doesn't seem very smart. And then, also considering from a capital adequacy standpoint, assets minus liabilities, the net assets at a fair value divided by its fair value of its assets is a ratio of about 3.6%, which is also a really low amount. So that tells us it's kind of a common equity ratio, right? That would be typical when you're assessing the capital adequacy, but converted to fair value rather than what the balance sheet value is, right? So 3.5% on that ratio is really low. We would typically see somewhere between 5 and 7%. So that leads me to believe that at fair value, the bank is pretty undercapitalized, and that might be part of why they're not paying dividends. They need to keep that capital within the bank, especially because when they're losing money and sort of trapped into low yielding loans and securities, right? So I feel like the bank is perhaps kind of in a tough spot, but somehow the market price for the bank's earnings and its net assets is really, really high. So people are willing to pay for it. Either that or they're just not, the investors just aren't aware of what's going on. Anyway, so let's keep going. Another thing to look at is the derivatives. I got a lot of text here explaining stuff, so I can break it down really quick. So what they have is about 413 million of cash flow hedges that are hedging FHLB advance rates. So basically it's hedging the liability side of the balance sheet, and it's fixing the rates, which I think is great, because if interest rates go up, then the rates they have to pay for these FHLB advances stays the same. And I think that's important in this environment because the market yields are much higher than what they're paying currently on their income statement, right? So if they were to reprice, they would reprice at higher rates than what's in the income statement now, and that would mean that they have higher interest expense. So I like that they're hedging and into receive fixed type of hedges. And it's the same thing on the loan side. On the asset side, they have 560 million of fair value hedges, which they talk about right here. And so basically they're converting some of the fixed rate loans on the asset side of the balance sheet and converting it into a floating rate. So if interest rates go up, then they get to take advantage of higher yields, I think, which is a great strategy as well. So I feel like they are taking maybe the appropriate approach on the dividends or the derivative side. But 413 million of securities or FHLB advances. I think they had 1.5 billion of debt. So it's maybe only a third or a quarter of the entire outstanding amount, but it's something, right? And on the loan side, this 560 million is hedging the loans, and they have total loans of about 7.8 billion. So it's not covering the entire thing. And of course, we don't know what portion is floating rates or fixed rate loans, but they're hedging the fixed rate loans, so it could be a larger percentage of those. But it's more than nothing here. So, but once we get down into more of the interest rate risk discussion in the MD&A part, we'll be able to look at all the assets and liabilities together and decide whether those derivatives are enough to counteract liability sensitivity, right? And hopefully put them sort of at a neutral asset liability management position. Okay, so now we're down in the MD&A. All right, so they encapsulate here in this paragraph a lot of what's normally a table. For most banks, we sort of have to read through things, but I mean, it basically explains what we already discussed. They have a pretty low net interest margin, 1.75%. We typically see somewhere around 3%, so it's basically half an average bank's net interest margin, which is not good. And part of it is due to the loans having a really low yield, 4.5%. That's just the interest earning assets of 4.5%. I mean, we're seeing most banks somewhere around at least 5.5% for the interest earning assets, right? So they're leaving a lot of yield on the table here. And then also they've got the on the interest bearing liabilities ends up being 3.38%, which is also kind of high. Yeah, and they speak to a little bit more of the provision here. So part of it's due to, an increase in non-performing loans, which is making them need to increase the provision. And part of it's due to one borrower with pretty sizable loan with the bank, but it looks like they are more than likely to be acquired, and so at that point the loan would hopefully be paid off. But here we go with the uninsured deposits, so 1.9 billion. That's about 24% of deposits, so not too bad. So I don't see a whole lot of risk there. Accounting policies. All right, so here we can talk a little bit about the interest rate risk, I suppose. So we can see here that they're really liability sensitive. So if interest rates were to go up, their net interest income would go down. That's pretty big risk, especially in this interest rate environment. You know, we do some of our own calculations with this as well to compare. We can look at the call reports and see when's the repricing timing of the assets, so like the securities and loans, and when's the repricing timing of the deposits and the debt, right? And see like, okay, well, what's the timing of the repricing of the assets and liabilities, and what's our risk if interest rates were to go up, if they were to go down, etc. And what we can see from that is that on the securities portfolio, most all of the securities reprice after a year from now. And also about 84% of the loans reprice after a year from now. So only, a small amount of the assets reprice within the next year. So, and if we take the deposits and consider the ones that are like savings accounts, money market accounts, like core deposits, I suppose, plus the time deposits that mature within the next year, it ends up being about 80%. So, so we're facing about 80% of deposits and actually about 60% of the debt reprices within the next year, but then probably less than a quarter of the assets reprice over the next year. So that puts us in a position that if interest rates were to go up, and especially in this environment where the yields in the market are a lot higher than what's in this income statement currently, right? It puts us in a position that when the liability side reprices, then interest rates, the interest expense becomes more expensive. But on the asset side, not as many of the assets repriced, so the interest income doesn't increase as much. And so that squeezes our net interest income even further, which it's already been squeezed, as we saw from this paragraph up here where it discussed how there's been a large decrease in the net interest income because of that, where the liabilities repriced sooner than the assets did. So I feel like there's a pretty big risk here for the net interest income and the repricing of its liabilities faster than its assets. And so that would, it's a risk to net income, which is already negative anyway. And then looking at the liquidity side of things, so we also do some of our own calculations related to this as well. And, we can see that they had about $375 million of cash. That was about an average amount. They also had about an average amount of securities. And if you were to look at the call reports, you can see that about 33% of the securities are pledged. So that means that the cash plus the unencumbered securities is about $1.4 billion. It's what we would call the on-balance sheet liquidity, right? And so that's about 18% of deposits, which is a really good amount. So, they've got pretty good liquid assets in place. Typically for that ratio, we would see somewhere between 13 and 18%. So they've got a really good amount of liquidity. But on the flip side, if we consider what they can borrow from outside of the company, I don't think they have as much of the average bank. So somewhere, I don't guess it was right here, but somewhere elsewhere in these financial statements, it said they have the ability to borrow about 2.7 billion from external sources. So that could be the FHLB, the Federal Reserve, etc. So when you add in the 2.7 billion off balance sheet liquidity to the 1.4 billion on balance sheet liquidity, it gets us about 5.2 billion, plus adding in some potential loans that they could pledge. So only about 81% of the loans are pledged. So they've got potentially maybe 19% of the loan portfolio that can additionally be pledged. And so we make some estimates around that, but that puts them at about 67% of deposits, which is a little bit on the low side of what we would normally see. Most of the time we see 72 to 80% of the deposits covered by on plus off balance sheet liquidity. So, immediate on balance sheet liquidity, I think they're in a good position. But from the bank's capital as a whole, that might not be the case when compared to other banks, right? And so then we've got the regulatory ratios here, which are pretty good. Those are actually really good average ratios. So they're really in a good regulatory ratio position. Of course, the residential mortgages basically have a 0% risk adjustment, right? So this ratio can be higher if you have more residential loans on your income statement. But anyway, so really good ratios there. And I think they also have about a million shares that they can buy. And that's about 0.95% of the shares outstanding right now. So, that's not enough to cover all of the stock-based compensation, where we saw that they've got almost 5%. So, I would assume that most of these purchases are going to be to hand out to the stock-based comp, right? But there could be a difference there. Anyway, so I think this gets us to the end, so we can kind of summarize things. After taking a look at it, the profitability is basically zero, right? They're not making any money. And so there's, we don't buy banks that aren't making money, so there's really nowhere to go from there. But you could also consider, what are some of the risks? What are some things that could happen in the future? Maybe the risks are really, really muted, or there's some kind of growth or something that would make sense to someday the bank will be profitable. I could get it at a really good deal. But after going through all the risk, I don't think that that's the case. With the credit quality, we saw that more than likely they don't have enough of a reserve to match the past dues and non-accruals, classified loans, etc. The reserve was about 0.71% of the loan portfolio, when most of our banks are at least somewhere around 1.10%. So I feel like the reserve might not be high enough, and we've already started to see that in this quarter, where they had to record a higher provision than what they typically do. So I feel like the credit quality risk is too high for us. And then from the capital standpoint, we saw that when we convert everything to fair value, it gets us a ratio of assets of about 3.5%, which is probably, it's almost half of what we would see for the typical average bank. So there's a lot of unrealized losses in their loans and their securities currently, and it's mostly due, I think, to their loans being at such a low yield. So that makes those loans being way less valuable in the market, right? And it's pushing down that capital adequacy ratio, but also pushes up the multiple of net assets that we would have to pay for their net assets. So it's just seems like it's way overpriced, but also perhaps not enough capital in place. And that's why maybe when we add in the on-balance sheet liquidity plus the off-balance sheet liquidity, it gets us a ratio of deposits of about 67%, which is also on the low side. So there's not enough fair value in their assets to allow for an adequate amount of borrowing were they to need it. So, and then on the interest rate risk side, we saw that they're pretty liability sensitive from the MD&A, but also when we added up all of the repricing timing of the assets and liabilities, we saw that less than a quarter probably of their assets reprice within the next year. Meanwhile, like 80% of their liabilities reprice in the next year. And so that puts them at a position if interest rates were to go up, and the yields are higher in the market than they are on their income statement currently. So that would make it to where when those 80% of liabilities reprice, they're repriced at a higher yield, and so the banks have to pay a higher interest expense. Meanwhile, only 20% of their assets increase yields. So there's going to be a mismatch in liability and asset side of things, which squeezes their net interest income even smaller and probably puts them at a loss. So anyway, all that to put together is they're currently losing money, and they've got all these risks over here that are possibly going to make them lose even more money. And then when you look at the market price wants you to pay 5 times its net asset value, when even a really good bank would be trading at 1.5 to 2 times its net asset value. So I think it's way overpriced, and there's too many risks and not enough money being made. So that is it. So definitely let me know if I missed anything, or if I'm confusing some things that make the pricing and the profitability appropriate. Let me know in the comments. Any clarifications that you think would be appropriate. Love to hear what you think about it. And yeah, thank you for listening.